this is John Michael Lust, Vice President of Operations at PlanScout. Today we'll be covering part 2 of using advanced tax planning in the SIPS retirement planning system. We'll be looking at how we can use advanced tax planning to automatically calculate dividends, capital gains, and turnover in non-qualified accounts. For clients with non-qualified assets, SIPS Advanced Tax Planning makes it easy to calculate these values and include them in their income tax calculations. These features are already live and are available in our SIPS Advanced subscription plan, so let's get started. So here we are with our sample client here where we've already enabled the advanced tax planning and added that to the account. Before we get into the details, I'd love to just define some of the terms that we'll be talking about in this video. So I'm going to go to our non-qualified account. I'm going to click Manage. And when we select the non-qualified investments, dividends, and cap gains calculation option, SIPS Advanced will automatically model the short-term capital gains, the long-term capital gains, and the dividends so we can tax those things at the appropriate rates. When we select this tax calculation option, we'll have 3 new fields here down below. And the first one is starting capital gains. This represents the unrealized gain if it's positive, or the unrealized loss if it's negative, within the account at the start of the plan. So in year 1 of the plan, what are the embedded gains or losses? So if we have a $750,000 account and it's got $600,000 of embedded gains, then we would put $600,000 here in this field. Average annual dividends tells SIPS how much of the hypothetical return percentage will be realized as an annual dividend and how much of it is going to be from capital gains. So if we have a hypothetical return of 5% and we put annual dividends of 2%, that means that 2% of that growth will be taxed as dividends, and the other 3% of that growth will be taxed as capital gains. Finally, the trading style or turnover field represents the percentage of the account that is being sold and repurchased over the course of a year. So if that's 0, that means that this account was never traded. It was essentially buy and hold. So as the account grows according to the hypothetical return, all capital gains will be taxed as long-term capital gains. At 50 means that 50% of the account is going to be sold and repurchased within a year. So that's going to create short-term capital gains for a portion, and then long-term capital gains for a portion of those that are realized each year. And then a 100 or more means that this is being traded at, everything in the account is being traded at least once each year. So we're completely turning the account over, and that means any capital gains will be taxed as short-term capital gains each year. So now let's start adjusting the plan, and we'll see how these different settings work in SIPS Advanced. So I'm going to go to a new scenario here, and we're going to look at starting capital gains. I'm going to go back to the non-qualified account, and let's put in, let's say 80% of this account has embedded capital gains. So $600,000 of starting capital gains. It's pretty high, but we want to make sure that we can see some impacts in the plan. So I'm going to click Save, and now we can see, in the first few years of the plan, that hypothetical growth rate is the same. The growth in the account is the same as in the previous scenario. But once we get a little further down into year 6, we can see that we're starting to generate some capital gains, or we've generated some more income taxes now compared to our initial scenario. So we can drill down a little deeper in that. We can go to our tax screen. We can create a tax scenario for year 6. We can call this our capital gains scenario. And we can see, our Social Security is still the same as before. That hasn't changed, although a larger portion of it is taxable now since we have more income. And now we can see the long-term capital gains. Now that we're taking withdrawals from the account, we're generating $55,000 of long-term capital gains. That is increasing our taxable income compared to the previous scenario, giving us a higher effective tax rate of 2.7% and $2,285 in taxes that year. Now let's go back to our income plan, and we can see what adding dividends will do for our income taxes. So I'm going to go to another scenario here for average annual dividends. I'm going to go back to our non-qualified account and click Manage. And now I'm going to add a 2% average annual dividend. So again, that means that if our hypothetical return is 5%, then 2% of that will be treated as a dividend and taxed accordingly. And then the remaining 3% will be taxed as capital gains. So let's click Save. And now we can see again, the growth in the account is the same at 5%. But now we've seen our taxes increase. Compared to the capital gains scenario where we were paying, $2,285 in taxes, now we're paying over $3,800 in taxes. So again, we can create a tax scenario for that year if we want to drill down deeper and see how these taxes are being calculated. So now, in the dividend scenario, we're generating over $13,000 in qualified dividends. Our Social Security income remains the same, although again, it's capped out at 85% of that Social Security being taxable. And our long-term capital gains have actually decreased. So it's important, this is a good reminder that when we add the dividends, a portion of that growth is going to be taxed as dividends, and the capital gains portion of that growth is going to decrease, typically. We can see the increase to our taxable income here with the corresponding increase in the effective tax rate and taxes paid in that year. So let's go back one more time. We're going to go to another new scenario here, and we're going to see what the trading style or turnover will do to this account. So I'm going to go back to the non-qualified account. And for the trading style or turnover, I'm going to put 25. So again, that means that 25% of the account is being turned over each year. It's being sold and repurchased. So we're going to have a portion of those capital gains being treated as short-term gains and a portion as long-term gains. So if we click Save, now we can see some big impacts to the plan. Remember, we had a pretty large embedded capital gain here of $600,000. So in these first 2 or 3 years of the plan, we're going to see some large tax impacts as we trade out of that embedded gain. Remember, we're trading 25% of that account every year, so this is creating some tax impacts for the client. And even in year 6, once we've traded out of most of those embedded gains, we still see higher taxes compared to the previous scenario. So again, our growth is the same. It's the same hypothetical return, but we're increasing the income taxes here as we trade out of those embedded gains. So let's create one last tax scenario. It's our turnover scenario, and we can see again our qualified dividends are pretty similar to what we had before. Same with our Social Security income. We're still capped out at 85% of that being taxable. And now with our capital gains, we can see a portion of that is being treated as short-term, and a portion of that is being treated as long-term. And we've got the changes to our taxable income and down below. And we can see the impacts to our effective tax rate, where we've increased that to 4.9%, because again, those short-term gains are in there being taxed at a higher rate, with $4,521 in the total taxes owed for that year. So just like that, we can see how the SIPS advanced tax planning functionality can help us easily and quickly calculate the tax impacts of capital gains, dividends, and turnover in a client's account to more accurately estimate their future income tax liabilities. Stay tuned as we share more information about all the exciting new features coming to the SIPS retirement planning system. For more information about planning resources and tutorial videos, please visit www.sipsplanning.com. And for more information about our outsourced financial planning services, please visit www.planscout.com. Thank you very much and have a great day.